Have you ever watched an asset and felt like it had a split personality? One minute it's this wild speculative rocket, and the next it's stable, almost boring. Well, there's a name for that. It's called a structural capital rotation. And today we are going to break down exactly what that means, using the crypto equity Bitman, or BMR, as our case study to see how this incredible handoff actually plays out in the real world. Seriously, think about it. You see a stock just soar and then it just hits a wall. It feels completely random, right? But what if I told you it's not random at all? In fact, it's often a sign of something incredibly predictable and powerful happening right under the surface. It's a changing of the guard. And to really get this, you got to meet the two main characters in this drama. First, you've got retail capital. This is the fast money, the nimble money, the money that gets fired up by a great story and pure momentum. And on the other side, institutional capital. This is the slow, heavy, patient money. They're not driven by stories, they're driven by spreadsheets, mandates, and decade-long plans. So that's really the framework for what we're talking about today. It's this tale of two completely different types of capital, how they operate, what they want, and what happens when they finally collide in the same market. The big idea here is what we call structural capital rotation. And look, this isn't just market noise or random volatility. It's a really profound, almost textbook shift in who is buying an asset and, more importantly, why they're buying it. It's the journey from a pure gamble to a foundational building block of a whole new ecosystem. All right, so let's jump into our first world. We have to start with the retail investor because they are the engine. They provide that initial spark, the raw energy and visibility that gets a new asset class off the ground. So where do we first see this retail energy bubble up? Well, a fascinating leading indicator is often the South Korean market. They are, in many ways, the canary in the coal mine. When a new wave of speculative excitement is building anywhere in the world, you often see the signs there first. And you might be asking, why there? Well, it's this really potent mix of a few key factors. First, they have incredibly easy, low-friction access to markets. Second, there's a real cultural acceptance of momentum trading. It's not frowned upon. And third, you have a high velocity of money. So when they decide to move, they move fast and with real conviction. But here's where things get really interesting. Sophisticated retail investors are evolving. They're not just piling into tokens on-chain anymore. They're increasingly using regulated stocks like BMR to get their crypto exposure. And why wouldn't they? It's just easier. The taxes are simpler, there are no private keys to lose, no custody headaches. It all just lives right there in your brokerage account. It's a game changer. Okay, now let's completely shift gears. We're moving away from the sprinters and the speed demons, and we're talking about the forces that lay the railroad tracks for the future. We're talking about the slow, deliberate, and unbelievably powerful world of institutional capital. I mean, this slide says it all, doesn't it? It perfectly captures the difference in mindset. The retail trader is asking, hey, can this thing 10x by next month? The institution is asking a totally different question. Can I reliably model this asset's yield for the next 10 years? They are literally playing two different sports on the same field. And before they can even play, they have this non-negotiable checklist. A pension fund isn't just going to ape in. Before they can deploy billions of dollars, they need to tick every single one of these boxes. They need to see scale they can verify, infrastructure they can trust, full regulatory compliance, and the holy grail, a yield they can actually predict and plug into their models. And this is precisely how a company like BMR is designed. It's built to appeal directly to that institutional checklist. It's not just about passively holding a crypto asset. No, it's about actively managing a treasury to control risk, participating in the ecosystem's infrastructure, and, this is the big one, generating a predictable digital dividend through staking. That's a cash flow they can actually model. So this is where it gets good. This is the moment of truth. What happens when the explosive, narrative-driven speed of retail capital slams head-on into the immense, unyielding gravity of institutional demand? Well, that's what we call the Great Handoff. This right here is the core concept. After that huge run-up, that big spike driven by retail excitement, you'll often see the price just stall out. And it might look like a failure, but it's not. It's absorption. It means that for every single share an early retail trader is selling to lock in a profit, there is a quiet, patient institutional buyer on the other side, just soaking it all up. And you can actually see the evidence of this on the chart. A classic retail-only top is a sharp price spike that then just collapses as the volume dries up. But an institutional handoff looks different. The price goes sideways, but the volume stays incredibly high. That combination, flat price, huge volume, that's the sound of shares moving from what we call weak hands to strong hands.
And as the ownership base changes, the story itself has to change too. The simple retail narrative of, hey, this is a proxy for ETH, it's going to 10x, well, that has to mature. It becomes a complex institutional thesis about yield generation, risk-adjusted returns, and discounted cash flow models. They're literally talking about the same asset in two completely different languages.
So what does the world look like after this handoff is complete? Well, the asset's behavior is pretty much permanently changed. A whole new market equilibrium is established. Now, if you're watching the price every day, this phase can be incredibly frustrating. It's choppy, it goes sideways, it feels stuck. But I want you to reframe that. That tension isn't a sign that something is wrong. That is the sound of a concrete foundation being poured for a new, higher price floor. Because here's the bottom line. In the long run, size and mandate will always win out over short-term emotion and hype. As more institutions come in, that patient capital creates deep, solid price support. The wild volatility starts to fade, and the asset's value becomes more and more tied to real, measurable fundamentals, not just what people are screaming about on Twitter. And that brings us to the final and maybe most important question of all. The retail engine gave us that initial explosive launch. The institutional force is now building the permanent structure. So the real multi-billion-dollar question is this: can that new, robust structure successfully capture and sustain the next wave of momentum? Because that delicate dance, that's where true, lasting value is created.